trade that damages you most may be the one you never chose for yourself. You entered because a voice sounded certain, a chart carried an arrow, or a message arrived at the exact moment your doubt became uncomfortable. If the trade fails, you lose money. If it succeeds, you may lose something more important, the habit of making your own decisions. That is the hidden cost of signals. They appear to remove uncertainty, but uncertainty is the condition under which every trader must operate. A signal can tell you where to enter, perhaps where to exit, but it cannot give you the judgment that makes those decisions meaningful. It cannot tell whether you are buying into strength or merely arriving after the crowd has exhausted it. It cannot make you recognize when the market's behavior has changed. Watch what happens when a trader becomes dependent on outside instructions. He stops studying price and begins studying the person giving the call. When the market moves against him, he does not ask whether his premise is broken. He waits for reassurance. Because responsibility has been transferred, hesitation replaces observation. A manageable loss becomes larger, not necessarily because the original idea was poor, but because the trader no longer knows what evidence would justify leaving. The market does not punish you for lacking predictions. It punishes you for acting without a clear reason, and then refusing to notice when that reason no longer exists. There is a practical difference between following information and surrendering judgment. Information may direct your attention toward unusual volume, a failed breakout, or a level where buyers previously defended price. Judgment asks the harder questions. What is price doing now? Who appears trapped? Is participation expanding with the move? Or is price advancing on weakening effort? Begin there. Before considering any trade, state what behavior would support the idea and what behavior would invalidate it. Notice whether price holds after breaking a level or quickly returns through it. Avoid entries that depend entirely on another person remaining confident. If you cannot explain the trade without repeating their conclusion, you do not yet understand the position you are taking. This does not mean you must reject research, tools, or the observations of experienced traders. Markets reward attention, and useful information can come from anywhere, but borrowed information must pass through your own reasoning before it becomes a decision. Otherwise, you are carrying someone else's conviction while exposing your own capital. And this is where the deeper problem begins. Because once you stop searching for signals, you are forced to discover what a sound trading decision is actually built from. The urge to find a signal usually becomes strongest when your own mind is least willing to remain still. Price begins to move, the opportunity appears to be leaving, and uncertainty turns into pressure. At that moment, you may believe you are searching for better information. Often, you are searching for permission. That distinction matters. Information improves the quality of a judgment. Permission only makes action feel easier. When another person says, buy or sell, the burden of choosing seems to disappear. The market is still uncertain, the risk is still present, and the future is still unknown, but your discomfort has been reduced. Because that relief is immediate, the mind can mistake it for evidence. This is how a signal gains authority beyond its actual value. The more anxious you feel before receiving it, the more convincing it appears afterward. Your emotional state changes, so you assume the market situation has changed with it. But nothing in price may be different. Only the tension inside you has been settled. Once that relief becomes familiar, a dangerous habit begins to form. You no longer wait for clear internal judgment, you wait for the feeling of certainty that arrives with outside approval. The signal becomes less of a market observation and more of a way to regulate emotion. On quiet days you search for one because inactivity feels unproductive. During fast markets, you search for one because acting alone feels exposed. After a loss, you search for one because making the next choice feels heavier than it did before. Notice the pattern. Discomfort appears, a signal removes it, and action follows. Each repetition teaches the mind that uncertainty must be escaped rather than tolerated. Yet uncertainty is not a temporary defect in trading. It is the permanent condition of the work. If you cannot remain composed while the answer is incomplete, You will repeatedly accept weak reasons simply because they arrive with a confident voice. There is another consequence. When the purpose of a signal is emotional relief, you become less interested in whether the idea is well supported. You begin judging it by how certain it sounds. A calm instruction feels safer than an honest expression of doubt. A precise entry can appear more credible than a conditional view. Confidence becomes a substitute for evidence because confidence is what quiets the mind. Ask yourself what happens when no signal arrives. Do you feel patient or abandoned? Do you continue observing or begin searching from one source to another until somebody confirms the action you already want to take? The answer reveals whether you are gathering information or trying to escape the responsibility of uncertainty. The practical work begins before any order is considered. When you feel compelled to seek a call, pause long enough to name the discomfort. Is it fear of missing the move? Is it boredom? Is it the desire to recover emotional balance after being wrong? Naming the pressure separates it from the market. You can then see that an urgent feeling is not the same as an urgent opportunity. Next, delay the search for outside confirmation. Give yourself enough space to observe whether the urge rises and falls without being obeyed. This is not hesitation. It is training. You are teaching the mind that uncertainty can be carried without immediately converting it into action. You do not need to eliminate emotion, and you should not expect to. The aim is to prevent emotional relief from disguising itself as analysis. Once you can recognize that disguise, a harder question comes into view. Even when a market idea is reasonable, what turns that idea into a trade you can actually execute? A market call can be right and still be untradeable. Buy may identify the eventual direction, but direction alone says nothing about the price you will receive, the risk created by that price, or whether the opportunity still exists when you act. Between a sound idea and a sound trade lies the discipline of execution. Suppose, hypothetically, that you are told a market is likely to rise. By the time the message reaches you, price has already moved sharply. If you enter immediately, you are not taking the trade that was originally observed. You are accepting a new price under new conditions. The direction may remain correct, yet your late entry can leave little room for further progress and considerable room for a normal pullback. This is why entry location matters. A good location gives the idea space to work without demanding an unusually large price movement. A poor location forces the market to continue almost immediately. When you enter after expansion, even a routine pause can place the position under pressure. The forecast has not necessarily failed. The price you paid has made ordinary market movement difficult to withstand. The same problem appears in the spread. When the difference between the buying price and the selling price widens, the trade begins at a greater disadvantage. This often happens when activity is thin or conditions are moving quickly. A signal may display one visible price, but your actual fill can be worse. The instruction remains unchanged while the cost of carrying it has increased. Order type also changes the trade. A market order favors immediate entry, but gives up control over the exact fill. A limit order controls price but may never be filled. Neither is automatically superior. The correct choice depends on what the idea requires. If the opportunity only makes sense near a particular price, entering at any available price defeats the original condition. If participation must occur quickly, waiting for a perfect fill may leave you outside the move. Timing deserves equal attention. A price level touched during orderly trading is not the same proposition when reached during a sudden burst of volatility. The quoted level may be identical, but the trading environment is different. Rapid movement can increase slippage, widen spreads, and make fills less predictable. Because execution conditions have changed, the practical trade has changed even if the written signal has not. Before acting on any call, translate it into terms that can actually be executed. What price range keeps the idea intact? At what point has the entry become too late? Is the instrument liquid enough for the order you intend to place? Is the spread normal, or has the cost widened beyond what the opportunity reasonably allows? Which order type fits the condition instead of merely satisfying the desire to participate? Then observe the difference between the price you expected and the price you could realistically receive. If that difference is large, do not pretend you are taking the original trade. You are considering a separate transaction, and it must stand on its own merits. Passing on it does not mean the market call was wrong. It means the available execution no longer supports the call. This distinction protects you from chasing accuracy after the opportunity has already changed. The person who identified the direction may later appear correct on a chart, while the trader who entered late records a loss. Both outcomes can exist at the same time because a forecast is judged by movement, while a trade is lived through price. Yet even precise execution cannot answer the next question. A trade can be entered exactly as intended, move in the expected direction, and still belong to an approach that loses over time. Because being right is not the same as having a mathematical advantage. A signal service can be right more often than it is wrong and still produce a losing result. That sounds contradictory only when accuracy is treated as the whole calculation. The market does not pay you for the number of correct opinions. It pays or charges according to how much is gained when you are right and how much is lost when you are wrong. Consider a hypothetical series of 10 trades. 7 produce gains of 1 unit each, while 3 lose 3 units each. The record shows 7 winners and only 3 losers, yet the result before costs is -2 units. The high win rate looks impressive because it counts outcomes without measuring their size. Capital, however, responds to size. The reverse can also be true. A method may lose more often than it wins and still remain profitable if its successful trades are sufficiently larger than its unsuccessful ones. This does not make a low win rate automatically desirable. It simply shows that frequency and magnitude answer different questions. Frequency tells you how often an outcome occurs. Magnitude tells you what that outcome does to the account. The relationship between these figures is called expectancy. In plain terms, you multiply the probability of winning by the average amount won, then subtract the probability of losing multiplied by the average amount lost. Trading costs must also be deducted. The result estimates what one trade contributes, on average, across a sufficiently large sample. It does not predict the next outcome. That last point is essential. A positive expectancy can include several losses in a row, just as a negative expectancy can produce an attractive run of winners. Short sequences are noisy. Because outcomes do not arrive in a neat order, a handful of successful calls cannot establish that an advantage exists. You need enough observations to see whether the relationship among wins, losses, and costs persists. Costs quietly alter that relationship. Commissions, spreads, financing charges, and slippage may appear small when each trade is viewed alone. Repeated frequently, they reduce the average gain and increase the effective loss. A method with only a slight advantage before costs may have no advantage after them. This is why a list of winning calls without net results provides an incomplete picture. Position size changes the consequence, though not the underlying expectancy. Increasing size does not convert a poor method into a good one. It only magnifies whatever mathematical condition already exists. If the expectancy is negative, greater exposure accelerates the damage. If the expectancy is positive, excessive size can still make normal losing sequences difficult to survive. When evaluating any source of signals, ask for the complete distribution rather than the headline accuracy. How many trades were measured? What were the average gain and average loss? Were open or unfilled calls excluded? Were costs included? Was every valid signal counted under the same rules? Without those details, the stated win rate cannot tell you what the method was worth. Apply the same standard to your own records. Do not group trades by whether they felt convincing or whether the market eventually moved in the predicted direction. Record the actual result of every trade under consistent measurement. Then compare average gains, average losses, outcome frequency, and costs. The purpose is not to make the numbers look respectable. It is to discover what the numbers are actually saying. Mathematics can reveal whether a repeated action has paid over a sample, but it cannot explain what forces produced the movement, where participation changed, or why a price was accepted in one area and rejected in another. For that, You must stop looking at the signal's result and begin examining the behavior of the market itself. A signal gives you an arrow. The market gives you a contest. One shows the intended direction. The other reveals whether buyers and sellers are actually able to carry price there. If you watch only the arrow, you miss the behavior that gives the move its meaning. Every transaction requires agreement on price, but disagreement about value. The buyer believes the price is worth paying. The seller believes it is worth accepting. When this exchange remains active within a narrow area, the market is showing acceptance. Business can continue there because neither side has created enough pressure to force a lasting departure. Movement begins when that balance is disturbed. If buyers become more aggressive than the available sellers can absorb, they must compete at higher prices. If sellers press against limited demand, they must accept lower prices. Price does not move because an indicator declares a direction. It moves because one side is willing to become increasingly urgent while the other side withdraws, yields, or is overwhelmed. The quality of that movement can be observed. A steady advance with brief, shallow pauses shows different behavior from an advance that repeatedly stalls and gives back large portions of its progress. Both may point upward on a chart, but they do not express the same control. In the first, opposing orders are being handled without much damage. In the second, supply is meeting each attempt and limiting its effect. Pace adds another layer. Fast movement often reveals urgency, but speed alone does not prove lasting strength. A sudden rise may come from aggressive buying, or it may be intensified by sellers rushing to close positions. Once those trapped sellers have finished buying back, the temporary source of demand can disappear. The important observation is not merely that price moved quickly, but whether fresh participation continues after the forced activity has passed. The response to effort is equally revealing. Heavy activity that produces little progress suggests that the opposing side is absorbing pressure. Buyers may be active, yet price cannot rise far because sufficient selling is meeting them. Sellers may attack, yet price refuses to decline because demand keeps taking what they offer. When effort increases but result contracts, control may be less certain than the surface activity suggests. You should also notice where price spends time. A market that moves into a new area and remains there is showing that participants are willing to conduct business at those prices. A market that visits an area briefly and leaves with force is showing rejection. Time, therefore, is not empty. It helps reveal whether the auction is establishing value or refusing it. This changes how you interpret a directional call. Buy cannot tell you whether demand is expanding, whether selling is being absorbed, or whether the rise is being driven by participants escaping poor positions. Sell cannot tell you whether lower prices are attracting new supply or meeting quiet accumulation. The same instruction can appear under entirely different market conditions. Train your eye to separate movement from control. Observe how much progress follows a burst of activity. Compare the strength of an advance with the strength of the response against it. Notice whether business builds in a new area or is quickly refused. Look for participants who acted late and may be forced to retreat if price turns against them. These details show who is under pressure and who still has room to act. None of this gives certainty. Market behavior is evidence, not prophecy. Its value is that it allows you to see the present contest instead of inheriting someone else's conclusion about the future. But observation alone does not tell you what to do. Once the market presents mixed evidence and more than one possible path, you still need a disciplined way to choose without pretending to know what comes next. A prediction asks the market to follow one path. A decision prepares you to respond to several. The difference appears small until price does something unexpected. Then the trader with a prediction must defend an opinion, while the trader with conditions only has to compare what is happening with what was required. A fixed forecast compresses uncertainty into a single statement: price will rise, price will fall, or a turning point is near. That statement may be informed, but it creates no instruction for the many outcomes between complete success and obvious failure. What should you do if the expected move begins but lacks force? What if price delays? What if the market moves in the opposite direction and then returns? The prediction names a destination without defining the road. Conditional thinking begins from a more honest position. You do not know which path the market will take, but you can decide what evidence would make one action reasonable. The structure is simply, if a defined condition appears, then a specific response becomes available. If the condition does not appear, no action is justified. If contrary evidence appears first, the original idea is removed from consideration. This approach does not weaken conviction. It places conviction where it belongs, in the quality of the process, not in one expected outcome. You are not required to believe that a scenario must happen. You are required to know what would make it actionable. Because your response is attached to evidence, the market does not need to agree with you in advance. A useful condition must be observable. If the market looks strong, is too loose, because its meaning can change after the fact. If momentum improves, has the same weakness unless improvement is defined beforehand. Vague language allows any movement to be interpreted as confirmation. Clear language limits that freedom and makes it harder to convert preference into evidence. Conditions must also be ordered. Some evidence matters only if it appears before something else. A setup that becomes valid after an opposing event may no longer be the same setup. Sequence creates context. By deciding which event must come first, you prevent yourself from collecting disconnected facts until they support the action you already want to take. You should also separate necessary conditions from supportive ones. A necessary condition must exist before the trade can be considered. Supportive evidence may improve the case but cannot replace what is missing. When this distinction is ignored, traders often treat several weak observations as equal to one essential requirement. Quantity then disguises the absence of quality. Before the session, write one idea in conditional form. State what must occur before action is allowed. State what would cancel the idea before entry. Then state what requires no response at all. This last part matters because markets spend a great deal of time offering movement without offering a clear decision. For example, a hypothetical plan might say, if the required condition appears within the intended time window, the trade may be considered. If the opposite condition appears first, the idea is discarded. If neither appears, there is no trade. The value is not in those general words, but in replacing them with precise observations relevant to your own method. Once the market opens, your task is comparison rather than prediction. You compare present facts with prior conditions. You do not need to explain every fluctuation, and you do not need to anticipate every turn. Either the required evidence is present, absent, or contradicted. That discipline narrows the decision and reduces the power of an outside signal to command action without context. But one well-formed decision is not yet a professional practice. Conditional thinking becomes dependable only when it is prepared, applied, and reviewed with consistency. And that requires a routine capable of producing evidence day after day. A trader without a routine begins each session by reacting to whatever appears first. A headline, a sudden move, or a message chooses the subject of attention. The day may feel active, but the evidence collected from it is scattered. When attention has no fixed process, experience accumulates without becoming reliable knowledge. A professional routine is not meant to predict the session. Its purpose is to make one session comparable with another. If you observe different instruments, use different reference points, and change your standards each day, you cannot tell whether the market changed or your method of looking changed. Consistency in preparation gives your observations a stable frame. Begin by limiting the field. A defined group of instruments allows you to become familiar with their normal pace, active periods, and sensitivity to scheduled events. Constantly moving toward whatever is attracting attention may expose you to more opportunities, but it also keeps you unfamiliar. Familiarity does not remove risk. It helps unusual behavior stand out against what you regularly observe. Next, establish the known conditions before trading begins. Note scheduled announcements, expected changes in activity, and periods when liquidity may be different from normal. These facts do not tell you whether to buy or sell. They tell you when ordinary assumptions may be less dependable. Because the context is recorded beforehand, you are less likely to invent an explanation after price has already moved. Preparation should also narrow the areas that deserve attention. A chart contains more information than a trader can use at once. Mark only the prices, time windows, or conditions that matter to the method being followed. This creates a boundary around your attention. Without that boundary, every fluctuation competes for importance, and the loudest movement tends to win. During the session, record observations in plain language. Note what was expected to matter, what actually drew participation, and where your reading differed from what occurred. Keep interpretation separate from fact. Price moved rapidly during the announcement. Is an observation. Someone knew in advance. Is a story. Facts can be compared later. Stories tend to change with the result. A short post-session review completes the routine. The question is not simply whether money was made. Ask whether you watched the intended instruments, respected the areas selected in advance, and recorded relevant changes while they happened. A profitable day can still reveal poor operating habits. A losing day can still contain disciplined work. If outcome alone grades the session, luck is allowed to approve weak behavior. Keep the review focused enough to repeat. A complicated journal that is completed twice has less value than a modest record maintained for months. The useful record contains the same fields each day, written close enough to the event that memory has not begun to improve the story. Repetition produces comparable evidence, and comparable evidence reveals patterns that isolated impressions conceal. You may find that certain times consistently produce confusion, that some instruments receive attention without offering usable opportunities, or that preparation becomes careless after an unusually active day. These findings are not signals. They are evidence about how your operation functions. Because they come from your own repeated process, they can guide practical adjustments without depending on another person's daily opinion. Set a fixed starting time for preparation, a limited watch list, a short list of known events, and a standard review template. Decide in advance what information deserves to be captured. The routine should be simple enough to survive dull sessions, losing sessions, and days when nothing qualifies. Its strength comes from continuity, not intensity. Preparation can bring you to the trade with clarity, but it cannot carry the position once risk is active. The moment an order becomes an open commitment, the work changes, and the unanswered question is who will govern the trade after the signal has done all it can do. The signal is finished the moment you enter. The position is not. From that point forward, price continues to change, time continues to pass, and the original reason for the trade may strengthen, weaken, or disappear. An entry instruction cannot govern those changes for you. Trade management begins with invalidation. Before risk is active, you must know what would prove that the trade no longer deserves to remain open. This is not the price at which discomfort becomes unpleasant. It is the condition that breaks the original premise. Without the distinction, an exit becomes arbitrary too close when ordinary movement feels threatening, or too far away when hope is allowed to replace evidence. A protective stop converts that invalidation into a defined boundary. Its purpose is not to guarantee a favorable exit. Fast markets can pass through a stop price, and gaps can produce a worse fill. The stop exists to limit discretion once the market has shown enough to reject the idea. Because risk cannot be controlled perfectly, it must at least be bounded deliberately. Profit requires management as well. An open gain is not proof that the position should be closed, and it is not proof that it should be held. The decision depends on what the trade was designed to capture. Taking profit at the first favorable movement may prevent the idea from reaching its intended potential. Refusing to take anything when the opportunity has largely developed may return earned progress to the market. Partial exits can divide those demands. Reducing part of a position realizes some gain while leaving the remainder exposed to further movement. But this only has value when the method defines why and when reduction occurs. If portions are removed at random, the result becomes difficult to interpret. Management should express the trade's design, not improvise a new design after every fluctuation. Time can invalidate a position, even when price has not reached a protective boundary. Some trades depend on movement occurring within a particular period. If that movement does not appear, the absence itself is information. Capital remains exposed while the expected behavior fails to develop. A time-based exit recognizes that a trade can become unproductive before it becomes visibly wrong. Exposure may also need to change when uncertainty increases. Reducing a position is different from reversing it. Reduction says the original idea retains some validity, but no longer deserves the same commitment. This can be appropriate when the opportunity has weakened without fully disappearing. The adjustment should follow a defined change in the trade's condition, not a passing reaction to noise. The person issuing a signal cannot perform this work for every follower. Each trader may have entered at a different price, carry a different amount of exposure, face different costs, and operate under different limits. One instruction sent to all of them cannot produce one suitable management decision. By the time a general update arrives, each position may already represent a different risk. Write the management rules at the same time as the entry plan. Define the premise, breaking condition, the protective boundary, the intended form of profit taking, and any time limit.